Markets continue to rally on tariff deal optimism, yet companies are slashing outlooks. Who's right? So we're solidly into the earnings season now, and investors are getting some mixed messaging. Obviously, in the last few days, we got some positive news on the macro front, with the White House starting to back down on their hardline tariff stance, as well as their feud with Fed Chair Powell. Yet, we're also seeing company after company warn consumer demand is slowing. Just on Thursday, a trio of airlines, American, Southwest, and Alaska, all rescinded their full year outlooks on the uncertainty. Meanwhile, Pepsi, Chipotle, and Procter Gamble all warned of slowing consumer demand. This all followed Monday's meeting where retail giants Walmart, Target, and Home Depot lobbied the White House to reduce tariffs. They probably drove home their point, warning of price increases and empty shelf shortages due to the tariffs. Conveniently, just the next day on Tuesday, the White House began softening its stance on China. Anyways, there seems to be a disconnect between the market's optimism and company forecasts. So, who's right? Well, it's unclear. However, we do see companies benefiting from being more conservative publicly. Even if companies thought the impact was more short term, the current macro uncertainty still provides cover for them to lower expectations. There's no point in raising the bar when the macro will give you a pass for lowering it. However, the slowdown in consumer demand is real and will be focused on the next few months. Meanwhile, markets have turned very bullish, betting on an imminent deal with China with a quick recovery, which is why they're mostly ignoring the company warnings. While not uncharacteristic, market optimism rallied, already pricing in likely a best case scenario. We're also cautiously optimistic with the White House's recent tariff de-escalation binge, but it's still all talk. Or in China's case, just talking of talk, since China has noted no discussions have actually taken place yet. While numerous countries are already in negotiations, China is still the main focus given its large manufacturing footprint and our intertwined economies. The trillion-dollar question is, can a deal with China to significantly lower or remove the retaliatory tariffs on both sides before consumers feel it? While the markets seem to be betting yes, this will likely be more complicated than the White House just announcing they're in negotiations. Again, the tariffs are already in place and set too high for any real meaningful trade to occur. Current retail inventories are still mostly stocked, but new shipments are likely halted, preventing new supply. How long until you probably see this in stores? That's still unknown, but it might happen sooner rather than later if Americans make a run on supplies and stock up, similar to what we saw at the onset of COVID. In any case, it puts a timer on the China deal negotiations. At this point, the market is betting a deal comes in on time.